Welcome to this explainer. Look, today we're moving way past the standard price action trading and giving you a clear, actionable blueprint for generating really predictable, reliable cash flow. If you're tired of your portfolio's success relying entirely on the daily whims of the market, well, you are absolutely in the right place. So let's dive into a concept that perfectly illustrates how you can build wealth without relying entirely on capital appreciation. We all know the standard drill, right? Buy growth stock, cross your fingers, and wait for the chart to go up. But what if the companies you already owned simply deposited cash straight into your account every few months, literally just for holding the equity? That's the exact structural advantage we're unpacking today. Here is our roadmap for today. We're going to cover the hidden return stream, the 4 critical dates you have to know, metrics to avoid yield traps, 4 simple investing strategies, and finally, the power of drip. All right, let's jump right into section 1, the hidden return stream. Just as a quick refresher on the mechanics here, this cash arrives on a strict schedule set by the board, and it's entirely decoupled from whatever wild stuff the share price is doing that day. Think of it this way. A dividend isn't some corporate perk or a gift. It is your literal, rightful share of a company's profits. Because you own the equity, you own the cash flow. When they profit, they pass a slice directly to you. And this is exactly what those standard price-only charts hide from you. Over decades, reliable cash distributions quietly close the gap and honestly, often completely overtake the flashy non-dividend growth stocks. When you look at a standard chart, you're only seeing half the story. But take a reliable stalwart, say Johnson & Johnson, those consistent, reinvestable cash distributions really stack up. They just compound silently in the background, totally anchoring your return. Okay, moving right along to section 2, 4 dates you must know. I know corporate timelines can feel like this massive bureaucratic maze, but let's just map it out using Apple's real-world 26-cent payout schedule. It kicks off with the declaration date. That's when the board officially announces the payout. Then there's the record date, where they check the register to see who actually holds the shares. Shortly after is the payment date, when the cash finally hits your account. But nestled right in the middle there is the absolute critical deadline, the ex-dividend date. Listen, if you buy on or after this exact day, the previous owner gets the cash, not you. Mark this deadline carefully. Under today's super fast T+1 settlement cycle, the ex-dividend date is usually the exact same day as the record date. If you buy the stock right when the market opens on the ex-dividend date, you are already too late for that quarter's payout. You've got to clear the trade the day prior. Let's pivot over to section 3, metrics to avoid yield traps. Think of these 4 metrics as your financial armor. Dividend yield is your baseline, how much income it produces relative to the price. But the payout ratio, that's your real safety check. Keep it under 60%. Seriously, if a company is paying out 90% of its earnings, a single bad quarter is going to slash your dividend. The dividend growth rate proves the actual health of the business. A steady 5 to 10% annual raise beats inflation no problem. And finally, yield on cost tracks your personal return based on your original buy-in price, totally ignoring today's market noise. And that actually brings us to the ultimate red flag. If you see a stock's yield suddenly spike to 10 or 12% while all its peers are sitting at 3, it is almost always a trap. Remember the math here. Yield is the annual payout divided by the current share price. A collapsing stock price artificially inflates the yield. Do not try to catch a falling knife just because the dividend looks generous on paper. All right, let's put all this into practice with section 4, 4 simple investing strategies. So here's an at-a-glance view of 4 battle-tested approaches. Your choice really just depends on how much active management you want to take on. Whether you want a highly passive 5-minute-a-year checkup, or you're cool spending a couple hours a quarter managing a sector-balanced portfolio, there's absolutely a path optimized for you. Strategy 1 is all about dividend ETFs, buying a single ticker like SCHD or VIG for instant, low-fee exposure to hundreds of pairs. It's the ultimate set-it-and-forget-it move. Strategy 2 targets market royalty, the Dividend Aristocrats. These are S&P 500 giants that have raised their dividend for at least 25 consecutive years. Faking a streak like that through the 2008 crash and the pandemic? Completely impossible. It proves profound business resilience. Now, if you want to completely strip human emotion out of the driver's seat, strategy 3 is the dogs of the Dow. On January 1st, you literally just buy the 10 highest-yielding stocks in the Dow Jones Index in equal weights. Hold them for exactly 12 months, then rebalance the next January. It requires zero judgment calls, and it naturally forces you to buy undervalued blue chips while they're out of favor. Or you can go with strategy 4, sector balancing. It's like building a balanced diet. Different sectors act as counterweights during different economic cycles. Utilities hold the line when growth fades, financials love higher interest rates, and tech leads during bull runs. By spreading your capital across these 5 core sectors, you smooth out the bumps and guarantee a way more predictable income stream. Which brings us to our final stop, Section 5, the power of DRIP. Instead of just taking that cash out to spend, a DRIP, or dividend reinvestment plan, puts every single penny immediately back to work for you. It automatically buys fractional shares of the same stock, commission-free. Those new shares then generate their own dividends, which buy even more shares. You're basically building a snowball of wealth at the top of a steep hill, just letting it gather mass entirely on its own. Let's actually look at the math here because it's wild. Assuming a modest 4% yield, if you just pocket the cash from a $10,000 investment over 30 years, you end up with $22,000. But by simply checking the DRIP box on your account, that exact same investment grows to over $32,000. That's a massive 47% difference for doing literally nothing. Your money makes money, and then that new money makes even more money. Understanding these simple building blocks completely transforms you from a market bystander into the architect of your own cash flow. The legendary investor John D. Rockefeller once said, "Do you know the only thing that gives me pleasure? It's to see my dividends coming in." So if you don't find a way to let your portfolio pay you while you sleep, how long are you willing to work? The real question is, what dividend strategy are you going to launch today?